Hello, good evening, ladies and gentlemen. Thanks for staying with us today. I know it's been a long day with a wide range of coverage, from semiconductors to broader economic outlooks. Definitely, you are flooded with tons of information today. So, for these sessions, I would like to keep things practical rather than technical. Instead of diving into complex investment concepts, I would like to share some investment ideas or some investment tools that can help you to preserve your capital while still earning a resilient return. Yep, apparently, as you can see on the screen, the topic we are going to discuss today is about fixed income, an asset class that doesn't get much attention as stocks, but it still play a critical role in building your portfolio. Maybe just for your information, my Julian colleague, just now he presented on the global fixed income portfolio. The difference between these two presentations is that for my sections, I will be focusing more on the single corporate bond. Okay, 3 seconds for the disclaimer. Let us begin with a little introduction to the fixed income. In the investment landscape, when we talk about fixed income, we are generally referring to bonds. Why? Because bonds are designed to pay you a regular interest payment, and also the main purpose for holding a fixed income or a bond is to help you to preserve your capital. Right. For those investors who are not so familiar with bond, I believe the illustration here will make it much more easier to understand. I suppose everyone here has experience in taking on a loan, no matter a car loan or your mortgage. A bond is actually very similar to your car loan. When you take out a car loan, the bank acts as a lender. They lend you money, they lend you the principal, and they will expect you to pay the principal as well as the interest payment on a regular basis, right? But when it comes to bonds investment, now your role is different. Now you are the lender. You become the bank. You are lending money to those issuers, whether it's a government or whether it's a company who needs funding. Okay. If I had to summarize the bonds or fixed income in just one word, I will use the word promise. A promise. A promise by the issuer to pay you a regular interest payment. Usually we call it as coupon payments in the bond market, as well as they will repay you the principal when the bonds matures. Most importantly, this promise is actually backed by a legal obligations. As a bondholder, you are actually the creditor instead of the owner. If anything goes wrong, or if let's say the issuer fails to fulfill their obligations, the bondholder has the right to take legal actions against the company. And when it comes to the event of liquidations, bondholders are generally get paid first before shareholder. This is also one of the reasons why bonds are considered less risky compared to your equities. Now, let's look at current market environment. I believe most of you are aware what is going on in the market. The equity markets have delivered exceptionally strong returns over the past 2 years, especially the semicon or memory chip sectors. Companies like Micron, companies like SanDisk, they have generated a very robust return to their shareholder. If you bought in this name early or even last year, congratulations, you have probably made a fantastic return. However, if we look at the valuation chart, published by JP Morgan. The S&P 500 forward PE ratio as of June stood at 20.4 times. If we solely look at the figures or the ratio, it simply tells us that the current market valuations are becoming more stretched. Okay, what does this mean? Does this mean that the market is going to fall soon? Or the market is going to continue its rally? The answer is, I don't know. I have no idea. Because I don't have a crystal ball to predict the future movement. No one will know what Trump is going to say, what Trump is going to do tomorrow, next week, right? As a fixed income analyst, my role is to look at the risk, is to assess the risk. Historically, when market reach a peak, investors will consider profit taking in order to secure their gains. If you look at the chart patterns, back in 1998, 2020, when the forward PE ratio exceeded 1 standard deviation above, market was often followed by a pullback. Right. I'm not saying that market will have the same movement exactly like what happened in the past. Okay. Because history does not necessarily repeat itself. But history could be a good lesson for us to take a look, to refer. So, at this juncture, it is time for you to take a step back and rethink. Is this trend sustainable? And where are you positioned yourself today? Should you remain offensive by adding more aggressive equities holding into your portfolio? Or should you remain neutral and not to do anything, just let your existing portfolio keep rolling? Or is it time for you to consider to turn to be more defensive by reducing your aggressive holding and reallocating your resources into a more defensive positions, for example, fixed income? If you are leaning towards a more defensive approach, today I'm here to tell you why fixed income could be the alternative investment for your consideration at this juncture from two different perspectives. First, from currency perspective, the ringgit has strengthened against major global currency since 2 years ago. For example, USD, Aussie dollar, what else? Korean won, Japanese yen, etc. This was mainly because of a relatively stable and supportive monetary policy in Malaysia. If we look at the USD MYR exchange rate, the ringgit has appreciated from the peak of around 4.7, 4.8, all the way down to 4.08 as of now. The same trend can also be witnessed in the Aussie dollar trend, with AUD MYR exchange rate declining from the peak of 3.4 until around 2.8 today. This means that your cost of traveling or your overseas transactions, overseas spendings have become much more cheaper today, including your foreign investment as well. So if you are the investor who have a natural need for foreign currency, or you anticipate that you will be having such a need in the future, let's say if you are planning to retire in Australia, or you are sending your child overseas for further study, now is actually a good timing for you to consider about foreign investment, a foreign currency bond. Second, from a yield perspective, when we talk about yield, we are referring to the returns from holding a bond, right? And it is also closely tied to the inflation rate in an economy. When inflation is high, the market will expect central bank to raise interest rate in order to contain the inflation. As a result, the bond yield will be adjusted higher accordingly. If we look at the US yield curve today, the red line is representing the latest, the current yield. It is actually higher than it was 3 months ago and 6 months ago. Why? This is mainly because of the inflation rates in the US economy. If you look at the inflation rate early this year in US, in January, the inflation rate was 2.4%. And in May, it has spiked up to 4.2%. Okay, because of the Middle East conflict. So owing to this, you can see that the yield has adjusted to a higher level today. The higher yield also means it's also something good for you as an investor because you are actually getting higher returns if you buy a same bond today, for the same bond you purchased today, compared to 3 months ago, compared to 6 months ago. Next, look at the Australian yield curve. The red line is slightly lower compared to 3 months ago because the Australian inflation was higher in the early of 2026. And in the latest data published by RBA, Reserve Bank of Australia, the inflation rate has moderated. So that's why you can see that the red line, the latest yield curve, is actually aligned with the inflations in an economy. Okay, next, I will tell you why we believe that we view that currently is actually a good entry point for you to consider about foreign currency bonds, no matter USD or Aussie dollar. If you look at the real yield chart, if you can remember, just now we mentioned that yield is refers to the returns from holding a bond, right? How about real yield? Real yield means that the net returns, the actual returns after adjusting for the impact of inflation. Can you follow me? Real yield refers to the actual return after pricing in the impact of inflation. So if you look at the real yield chart in both economy, US and Australia, both of them are actually showing a positive real yield. It means that if you purchase a 10-year government bond today, after adjusting for the impact of inflation, you are actually getting a net positive return, net real returns of 2%, right? Which is considered is a decent investment from a relatively stable instrument. Let me give you a real life examples. Okay, fixed deposits. I believe many of you have a fixed deposit placement with your bank, right? Can I have a little bit interactions with every one of you? Can you raise your hand if you have fixed deposits with the banks? Yes. Yeah. Thank you. Thank you. Okay. It looks like some of you do have. This is the problem. In Malaysia context, if we look at the 1-year FD rate, it's around 2% today. It's around 2.1, 2.2. Do you think it's enough to keep up your inflation? For your information, the latest inflation rate in Malaysia in May was 2%. It means that if the inflation goes beyond 2% today, your saving, your money is actually losing value in real terms. Okay. So, owing to this, in order to preserve your capital and maintain your purchasing power, you may consider about fixed income. You may consider to include fixed income as part of your portfolio. Now, I believe some of you may be thinking, how do I actually start? How do I actually start a bond investment journey? And where can I start? For the remaining part of my presentations, I would like to briefly walk you through how can you actually construct a fixed income portfolio with FSMOne. In the past, bonds were only traded on OTC, over the counter, which made them less accessible to retail investor, right? If you look for the other brokers out there or other banks out there, investors typically need a massive starting capital of 250K just to purchase one single bond. Okay? With FSM, we have launched a bond marketplace. Okay? Think of it as an exchange for bond. On this exchange, it offers you a greater visibility, a greater transparency, where you can view all the transactions or you can view all the informations like bid ask price, bid ask volume, prevailing market price, etc. If you are comfortable with the prevailing market price of a particular bond, you can purchase the bond with just one click. You can just hit the buy button and you can purchase the bond. And most importantly, the minimum capital required to purchase a bond is as low as 1,000 for corporate bonds and 100 for government securities. Next, just in case you have no idea what to buy and how to construct a fixed income portfolio, I have prepared some examples for you to consider. So look at this table. You can see that with just 4,000 Aussie dollar, I can actually construct a fixed income portfolio and gain exposure to 4 different bonds issued by the leading banks in the world. Right? By combining the bonds with different coupon payment schedule, you can actually expect a more consistent income stream from your bond investment. So in this example, you can see that the coupon payment schedule is different. But when I combine them into a portfolio, you can see that the income generations from this bond is actually covering 10 out of 12 months in a year. So meaning, if you have no idea what to purchase today and you follow the list here, the recommendation list here, you can actually expect there will be money flowing into your account every month. Of course, not every month because there is a 2-year gap. You may consider adding another bond into your portfolio to fill up the gap as well. Just in case if you don't like Aussie dollar, we have USD opportunity as well. You can also participate in some opportunity offered by the market leader. Let's say, for example, CoreWeave, a tech company that specializes in AI cloud computing, is offering a very attractive returns at 9.3%. Of course, investors are not limited to Aussie dollar and US dollar. We do have other opportunity as well. Through our platform, investor can access to fixed income opportunity across the global market in up to 8 different currency. Another unique feature I would like to bring out is that we do have an in-house fixed income research team that will provide regular updates and insights on the issuers, including the company's background, including the company's credit profile. So if you are interested in gaining deeper insights into the issuers behind the bond, feel free to visit our fixed income or bond page on FSMOne. Okay. Last but not least, before I conclude my sections, I would like to summarize a key takeaways from my presentation just now. First and foremost, the main purpose of holding a bond is for capital preservation rather than capital gain. Of course, there may be opportunity for you to enjoy the capital gain, but please bear in mind, it is not our primary objective. If you are looking for some investment tool that will give you unlimited upside potential, fixed income might not be so appropriate for you to consider. Second is about slow but stable. Fixed income or bond is not a tool that will allow you to become rich overnight. Instead, it helps to protect your capital and it grow your wealth in the longer run. Next takeaway will be good time to start. As mentioned, about the real yield, about the favorable exchange rate. Now is actually a good entry point for you to consider about bonds. Okay. Last but not least, there is a caveat for our investor here. Although I mentioned that bonds are considered as a safer instrument compared to your other investment tool like equities, like your ETF, like your unit trust, but it does carry risk as well. So before buying a bond, the first thing you need to do is to evaluate the issuer background, including their credit profile, including their credit positions, just to ensure that they have the ability to fulfill their obligation. They have the ability to repay you with your coupon payment as well as your principal. Okay, with this, it comes to the end of my presentation today. If you would like to know more about bonds or if you have queries that you wish to clarify, please visit our fixed income booth out there. My colleagues are there and they are ready to assist you. Thank you, everyone. Once again, thanks for joining us today.